Are getting some breaking news out of the Fed. For that, let's get to Steve Leisman. Hey, Steve.
Hey, Carl. Yeah, timing's everything. You ask about Schmidt. We got Schmidt here, Kansas City Fed president, who dissented at the last meeting, saying monetary policy is modestly restrictive. And that, he says, is where it should be. He suggests in the speech he's about to give his intention to oppose additional cuts again in December. Says mind could change, but right now that's the way he's leaning. Cuts, he says, won't help the labor market much, but could have a lasting effects on inflation and inflation expectations. He says it's too high. Meanwhile, he says the economy shows momentum. He sees strong consumption and solid gains in capital spending, a big part of his outlook here. He hears continued concern from his contacts in his district about the pace of price increase and not just about tariffs. Healthcare costs, insurance, electricity, a whole range of things, and he sees inflation spreading. The most recent data, he says, shows inflation is above 3%, going to remain there and spreading, and he's concerned that persistent inflation could cause this idea of price increases to become ingrained in people's psyches and force a sharper rate increase down the road. Policy, he says, should lean against demand growth right now to relieve pricing pressure. And quickly on this discussion you were having about the labor market, this is Schmidt's idea. He says it's cooling, but largely in balance. It reflects more structural changes than cyclical changes. And the payroll break-even rate, the one needed to keep the unemployment rate from changing, his staff suggests is just around 50,000. And then one other observation he makes, which is a big part of his thinking, and other more hawkish members of the Fed, they look around and they do not see things indicating tight monetary policy in equity markets being at or near all-time highs, narrow corporate bond spreads, and very robust high-yield issuance. Guys?
Okay, so this gets at the point I was just making. I wonder if they're opening themselves up here with arguments like that to, well, the Fed's just making monetary policy then for people who own stocks, people who are investing in data centers, tech companies. He cited the high levels of capital spending. That is not reflective of the entire economy. And when you say it's not that restrictive, go tell that to the now 40-year-old first-time homebuyer.
I hear what you're saying, Sarah, and I think there's a lot of good ideas in that. I guess that he would counter and the hawks would counter that they have to make policy for the aggregate economy, and they have really just one tool. And if the CapEx numbers are higher, regardless of whether there's a single source to that CapEx, the Fed has to react to the aggregate number. If the overall GDP numbers show growth, and we're going to get a lot of data hopefully soon that shows whether or not that is the case. If the overall GDP data shows that there's growth, even if only a few sections or sectors of the economy are part of that, the Fed has to react to that aggregate number.
I get it, of course.
If there are individual sectors of the economy, Sarah, that are showing problems, that's more the provenance of the fiscal side. If they want to help housing more, they can help housing more. If they want to help non-AI investment more, well, they can help non-AI investment. The Fed can't do that by sector.
I guess so, but they have one tool, and their tool is interest rates. And what do interest rates control? They control mortgage rates, they control borrowing rates, and things like autos, which is also showing some stress, and other parts of, the consumer economy. Part of their mandate is to address the labor market, which has shown signs of weakness. So I don't know. You can make this argument on both sides, which is why it's so fascinating going into this meeting. Steve, I wonder, so it sounds like Schmidt and Collins would be dissents if the Fed keeps cutting.
Yeah. I'm fascinated by the pickle that Powell is in at the moment. As I game this out, I think he has 5 or 6 potential dissents here. You mentioned some of those that were on the fence.
Yes.
Maybe, by the way, Kashkari last night, we could talk about next year's board as well. Kashkari last night said he did not support the October rate cut, even though he did not have a vote. Bostic was similar in that regard in terms of future cuts. But in terms of voters, I think he could have maybe 4, maybe 5 dissents for a cut, and he would almost certainly have 3 for if he did not cut. So this is not good in terms of the way, the impression it gives. And I think the only hope that he has right here is that as you were suggesting,
the data.
Economic data comes out, it's definitive one way or the other, and that allows the Fed to coalesce around a majority or a much more clear majority decision.
I know, but what are we going to get? A September jobs report, hot or cold? It's old news.
No, we're going to get. I think we're going to get November. We're going to get the November jobs report, and we will get. I think it's. I'll check my calendar on this. I think. No, we should get November before the December meeting. I think, right?
Yeah.
For the month of November.
Yes.
October is the black hole that will. The black hole forever, where light goes in and nothing comes out. Apparently, we also get. The CPI report for December, I believe, on the second day of the meeting. and I don't know where the PPI comes out in that regard. I talked to somebody at the BLS, and this person was just waiting for instructions. One of the economists who heads one of the divisions, I had a background conversation. He's like, call back in a little bit when I know something. There's a page on the website that has the heading for the dates for the new releases, but the page is blank. And I'm refreshing it every other minute here.
That was supposed to be today, by the way, PPI for November 14th. Thank you, Steve.
Steve, thanks.